The second quarter earnings season is still underway. In fact, as we speak, we're in the thick of it. There have been some strong earnings surprises, especially by some industry bellwethers, but despite that, initial market reaction to some of those reports has been somewhat lackluster. Our chief equity strategist and economist, John Blank, is here now to help us understand what's going on. John, is this because these strong earnings with easy comps had been priced into the market for a while?
Simply put, Terry, you answered your question. Yes, that is true. I mean, I'm looking today on July the 29th, and I'm seeing a blended earnings growth rate for the S&P 500 at 74%. This is the highest growth rate since the fourth quarter of 2009. And if we went back a month ago, the earnings growth rate was already at 63%. So earnings are coming out 10% stronger, Terry. But when you're doing 10% stronger on a 63% upgrade, it's basically irrelevant.
So according to published reports, the second quarter earnings season could establish somewhat of a high watermark for the rebound U.S. corporate profits have undergone since last year's coronavirus-induced pain. But do you expect the nice beats we've been seeing to come down later, say in Q4, as the comps get a bit tougher?
Yeah, absolutely. I mean, this probably is peak growth because of the base effects going back to the shutdowns last second quarter in 2020. And so, yes, I do expect the beats to go down. And again, the market will not care because it's all been priced into.
So is it accurate to say now that strong earnings are tempering the market's concern over inflation and the resurgence of COVID infections as a result of the Delta variant?
Yeah, that's absolutely the case. I was looking this morning about European earnings, what's outside the United States. And again, all across the board, particularly with mining companies, energy companies, even, Nestle type companies, everybody's doing quite well over in Europe as they open. So it's clearly an opening trade. And this morning we got the Q2 GDP report, and it showed across the board, no matter what you looked at, sub-variable, it was all about COVID reopening evidence of spending growth.
Treasury bond yields have soared in recent weeks. Does this suggest that investors are moving cash into bonds because they see weakness going forward?
The Treasury bond is all manipulated by the Fed. I mean, you got to remember there's $120 billion a month in mortgage-backed and Treasury purchases going on by the Fed. And of course, people think tapering down that number is coming. But Powell is up for his second term, the February of 2022, it's very unlikely that Powell will stop in front of that and make a change. So market's pricing in the fact that Jerome Powell is not going to do anything for sure until after he gets a term or he doesn't.
As the market then climbs the wall of worry, is downside market risk increasing? And if so, are you expecting August and September to be troublesome months for the stock market?
Well, Terry, there's 80% of people are bullish in the stock market, according to the latest JP Morgan survey. And half of those people have a 4,600 price target for the S&P 500. And when we're talking on July the 29th, is above 4,400. So how do we get 200 points out of the S&P in 5 months? Well, you can do the math. That's, going to be about 40 points a month or about 10 points a week. And that's just kind of a slow grinding exit from this year. I guess that's probably the right consistency with the trend and what we're talking about in terms of earnings growth.
Market also seems to be shrugging off inflation concerns, hotter than expected inflation data, and the resurgence of those COVID infections. So is the bull and buy the dip story still intact?
Yeah, I think so. The Delta variant is pushing a bullish story forward, which is forcing a lot of vaccination rates to go up, and people are going into the CVSs of the world and all the other pharma companies and getting their shots. So it's making the case much more widespread. The actual coverage in the United States is around 50% anyways. So again, if you look at Israel, say at 65% coverage versus the United States at 50%, what we're buying here is probably that 10 or 12% of people that have been really resistant and maybe getting them to move on this stuff.
How should investors then play the second half of the year?
Trend is your friend, Terry. I mean, it's a bullish market, and Powell's not going to taper till after February, if at all. And so you stay with the money flows, and that's what you do.
What's the current story on the global markets? Are European earnings peaking?
European earnings probably are not peaking because they are a little further behind in their vaccination rate. So it might be the case peak in European earnings is next quarter, not this one.
And against this backdrop, let's look at a few recent market leaders, namely Brookfield Asset Management, home builder Lennar, and retailer Best Buy.
Yeah, let's talk Brookfield, BAM. I mean, this is the number 2 ranked stock. Value score is B, growth score is B. Fantastic stock. Just to give you the idea how strong this stock has been, the last earnings surprise was 310%. The average of the last 4 surprises, 180%. So the only question here again is if this is overdone, but truly kind of an interesting story here because they're a real estate company. You would have thought the office businesses didn't work, but we're seeing that not the case for them. They're actually getting stronger because they're probably lowering their loss reserves now that people are coming back to offices. Lennar, strong home building company, number 1 rank, but still a value score of B and a growth score of D, which is kind of interesting. Now, you say to yourself, why is Lennar a growth score of D? This is interesting because they cannot build the homes they would like to build because of the land constraints out there in the marketplace. But still, really strong stock because they're selling the homes for a nice price, and that's what's driving up Lennar earnings. Best Buy, ticker BBY. Value score of A, growth score of B. You gotta run Zach's rank that's gone back to 3. It's probably just earnings lull here. It's a strong chart for Best Buy. This is a company that's really found a way to work the internet and its big box stores and deliver things to customers that they want. You gotta like this stock. It's a P ratio, forward PE of 13, so it's also not overvalued, and that's the key here, is that Best Buy is you can still ride this trend pretty safely.
All right, our chief equity strategist and economist, John Blank, bringing us up to date once again on the markets. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.